This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Dr. Lacy Hunt joining us from Austin, Texas this morning. Lacy is an internationally known economist, executive vice president of Hossington Investment Management Company, a firm that manages over $5 billion for pension funds, endowments, and insurance companies. Welcome, Lacy.
Nice to be here, Gordon.
I'm sure it is. We were just talking how compared to what I have here in Boston. And what did you say the temperature was there?
The high temperature today is 60, and that's actually a little cool for us. We did get up to 77 on Tuesday.
I envy you this time of year, but it does get a little too hot for me in the summer. But maybe that's that Canadian blood in me from when I grew up. Lacy, so we don't run out of time, let's begin. Could you just give our listeners a brief outline of your background at Hossington, just they're aware of the things you do?
Well, I after earning my PhD from Temple University about 4.5 decades ago, I went into the Federal Reserve at Dallas. I'm a native Texan. I thought I'd stay in Texas, but I joined the econometric subsidiary of Chase Manhattan back in the days when it was run by David Rockefeller. I was chief economist of the largest bank in Philadelphia, and then I was the chief U.S. economist for HSBC, which at the time was the largest bank in the world. I've been here at Hoisington for 19 years.
Lacy, this is part of a series we've been doing on financial repression. Though I want to really talk about this great report that you just put out. But to begin, could you describe what you believe financial repression is to our listeners in your own words, or the things that you're seeing that would support that that's what we have now?
Well, it's basically a superficial attempt to deal with the excessive indebtedness that grips the global economy, not just the U.S., but Europe, Japan, the United Kingdom, and even now China and the emerging markets. And in my opinion, it will not work. Monetary policy is not the solution here. There are fiscal policy solutions, but they required shared sacrifice, strong leadership, something we don't have in the United States, they don't have in Europe, no one has. And so basically, what we're ending up doing is we're trying to solve an extremely over-indebted situation domestically and globally by taking on more debt and aggravating the problem. So rather than bringing us closer to the return of the normal business cycle, they're pushing it all further and further into the future.
Yeah, the longer we go without a healthy correction in the business cycle, which is a natural process, we don't get the cleansing of malinvestment, we get distortions, mispricing of risk, lack of price discovery, etc., which just feeds on itself. And as you said, my opinion, you can't solve these structural problems with monetary policy, even if you think it's a good one. You need fiscal policy, you need public policies, a lot of other levers here to steer the ship.
Yeah, but you don't need more indebtedness.
No.
Debt is an increase in current spending in lieu of a decline in future spending, unless you generate an income stream to repay principal and interest. Unfortunately, there are three types of debt that are not good. There's the unproductive, which when you borrow to finance daily living needs, that doesn't generate an income stream. Then there's the type of debt that leads to bankruptcy. That doesn't generate an income stream, may generate even a negative. And then the worst type of debt, which Kindleberger identified, is where the excess debt creation inflates asset prices. And then that ultimately leads to economic instability. And the world now, depending on how you want to measure it, has approximately $35 trillion more of debt than in 2007. We're not in the age of deleveraging. We're still in the age of leveraging up. Unfortunately, the overleveraged condition now is virtually everywhere in the world.
You know, debt brings consumption forward, which can be a good short-term solution, but it brings demand forward. But if in fact the demand is just used for consumption and it's not creating cash flow or returns or is being applied to productive investment, that debt just eventually overwhelms you. Is that a correct way of looking at it?
That's correct. When we take on debt, draw the saving rate down, that's buy now, pay later. But there becomes a point when the pay later overwhelms the buy now. And that's where we are, domestically and globally.
Lacy, this report that I mentioned and that you put out, your Q4 report, and I just read this morning, John Malden was out saying it's absolutely must read, which I fully agree with him. I have up here on the screen right now just a quick outline of the report, of the various areas. Could you kind of just step us through it and highlight what the key points, messages you were trying to relay to readers?
Well, I think that what we've been trying to do, not just in this report, but that we've been doing for quite a number of years, is we've been working with the basic theme that when you have extremely over-indebted economies, you are subject to structural downturns as opposed to cyclical downturns. Cyclical downturns are what people generally understand. That's where you exhaust pent-up demand, where you get inflationary pressures. The inflationary pressures produce higher interest rates. And the monetary authorities tighten conditions. But the monetary authorities can reverse those types of conditions. But when you become extremely over-indebted, the normal business cycle still tries to operate, but it doesn't operate in the normal way. It's basically overwhelmed. And the symptom, there are a variety of symptoms of the extreme over-indebtedness. One is that there's a weakness in aggregate demand, and it's persistent. There can be periods when economic growth accelerates, and we've seen those, a few quarters here, a few quarters there, but they cannot sustain themselves because we get the accelerations by taking on more debt. And there is a transitory benefit there, but it fades out very quickly. Another problem of the extreme over-indebtedness is that you bring downward pressure on inflation. And inflation falls to abnormally low levels, and it opens up the risk of actual deflation, which we're seeing around the world. Because the long treasury rates and long risk-free rates are really a function of inflationary expectations in the final analysis, not over the short run, but in the final analysis, that drives down the long-term rates to incredibly low levels. The real rates don't necessarily fall, because if for example you get a 2% 30-year yield and the inflation rate is 0, you still get a 2% real return. And if the inflation rate is negative 0.5%, then you get a real return of 2.5%. Many people forget that relationship. If you're a non-leveraged investor, you get paid back in harder dollars. But there are a couple of other symptoms of extreme over-indebtedness. In addition to the ones that I mentioned, the velocity of money falls. This puts Federal Reserve policy and central bank policy out of the game. Also, you bring the short-term rates down to 0, so you no longer have price effects. And the final symptom, which we tried to highlight in our latest letter, is that over-indebted situations force countries to use a option that carries with it very serious risks. and that is currency depreciation. If you use monetary policy or other means to devalue your currency, here you can get a transitory benefit. But ultimately, what happens is there is retaliation. And so what we did in the latest letter is we looked at the period from 1926 to 1939, when the German tanks rolled into Poland. And it's a very, very similar period to what we are in today. The world was extremely over-indebted. There was the problem with the World War I debt. Countries tried to bring their economies back by taking on more debt. There was financial speculation. There was substantial financial speculation in some parts of the world that were not war-torn. For example, in the United States, Canada, Australia, parts of Latin America. And as the over-indebtedness problem began to rear its head, the pay later overwhelming the buy now, countries were forced to devalue. In that time period, the process started with France in 1926. France had a lot of problems. England and most of the other countries in the world, when they returned to the gold standard, they restored the pre-war price. France did not. They devalued very substantially. Now, the world didn't like that, but they let France get away with it because they knew the problems that were pretty serious. Unfortunately, the French devaluation set off a chain of events. By the time the British devalued in 1931, there had been 30 devaluations, a lot of de facto devaluations in the form of tariffs or import quotas and the like. And so a country got an advantage, but then it was immediately reversed. The United States devalued by 59% between April of 1933 and January of 1934. That gave us a little lift, along with a reversal of the inventory cycle, and the Depression seemingly came to an end for a while. Unfortunately, our devaluation of 33, 34 had repercussions. And that forced China, who was on a silver standard, to devalue. France fell again, even though they had started the process. Belgium, the Netherlands, the other gold bloc countries, they devalued. Italy, under Benito Mussolini, devalued by 59%, identical to the devaluation in the United States. In fact, one of Mussolini's advisors said our action was economic warfare. So the problem is when you engage in these beggar my nation policies, sometimes called beggar thy nation, you lower the standard of living of your country. And then when someone else retaliates, they lower the standard of living in their country without raising your standard of living. And if multiple countries engage in it, you're in a race to the bottom. For example, if you read the statements of the Bank of Japan with their numerous efforts at quantitative easing, they always mention that one of the channels of mechanisms whereby quantitative easing is going to work for them is going to lower the value of the yen. When the European Central Bank announced quantitative easing, what was at the top of the list? Depreciation of the euro. The Australian, the Reserve Bank of Australia cut rates last week. And one of the reasons they gave was to cut the value of the Australian dollar. But that doesn't work. It perpetuates the deflationary process. And right now, even though we benefited from a lower dollar transitorily in the early phases of quantitative easing, the dollar is now rising, much like it did there from 1926 to 1933 when we finally retaliated. And that's pumping in the economic problems, the deflationary forces of the rest of the world into the United States. And that's that's the main thrust of our letter.
It's very similar. I was listening as today with 1926, you mentioned France really effectively kicked it off with their devaluation, but everybody cut them a fair bit of room because of the issues with the First World War. Today, that would have probably been kicked off with Japan and their rate of debasement, if I want, and driving down the yen, and then quickly others beginning or being forced to follow. It seems like the roadmap is an incredible parallel here.
Yes, and one of the most interesting
and we knew it didn't work then, right?
No, it didn't work then. And if you look at the G20 summit that was held this week,
yes. What
were they all agreed on? The mechanism was they were going to live. They were all to devalue their currencies. But no, it's actually destabilizing. And we know this from historical experience, but we also know it by economic theory, something known as the Nash equilibrium, developed by John Forbes Nash, Nobel laureate in economics, of Beautiful Mind fame,
yeah.
By Ron Howard with Russell Crowe playing. If you take an action with a party that you're in a business relationship, you don't control their outcomes, and you take a harmful action, then they're going to retaliate against you. This is not a process that we should go down. And I think that the risk is that the process goes on. Now, the world was very fortunate in one sense. World War II was not a fortunate event, but it brought that process to an end between 1926 and 1939. And when we entered the war, the rest of the world was willing to take whatever product we could sell them, from the mines, the factories, the farms, and they paid us in gold or whatever assets they had. Sometimes they wrote us checks or we took their IOUs. And fortunately for the United States, we instituted rationing. And our saving rate, which at the start of the Great Depression was about 5%, went up to 28% during World War II. And due to fortuitous circumstance, we paid off the excessive indebtedness of the 1920s. Keynes, shortly before he died, wrote an article on secular unemployment. And he said we would return to the Great Depression unless we engaged in massive deficit spending. Well, we didn't return to the Great Depression. In fact, we had a post-war boom. The United States was the engine of growth for the rest of the world, which shows that Keynes didn't really understand what caused the Great Depression. The insufficiency of aggregate demand, which he was so concerned about, was a symptom. The debt was the underlying cause. And so we had a fortuitous circumstance. Our balance sheet was clean. Yes, we had some cyclical recessions from the late 40s into the 1970s, but they were easy to handle. I mean, they got a little testy. We had some difficult 1 to 2 year declines. And people were alarmed, but 1 to 2 years is a short period. And then we had 3 to 7 good years. And there were no major structural impediments, really, until the late 1990s, when public and private debt moved into this range of 250 to 275% of GDP. And what a large number of academic studies done both in the United States and Europe, and there are now more than a dozen of these studies, maybe 15 or 16, indicate that when debt reaches into that range, it has a deleterious impact. The studies generally show that once you get into these high reaches of debt, you lose about a quarter of your trend rate of growth. So if you've been growing at 4, you're not going to grow at 3. But a number of the studies identified a nonlinear relationship. When the debt gets to these high levels, and continues to rise, the economic growth rate deteriorates faster than the rise in debt. And we can see that in the United States. Our per capita GDP from 1790 to 1999 grew about 2% per annum. Since then, the last 15 years, we've only grown 1% per annum. We've lost almost half, not a quarter, but almost a half. And our public and private debt is about 370% of GDP. Europe is almost 100 points higher. That's the Euro currency zone. The UK is above Europe. Japan is around 650%. And what is important is that since 2008, we've seen a massive leveraging of China and the emerging markets. After 2008, the United States deleveraged a little bit, not enough to get us back into that range of 250 to 275, but Europe continued going up, and Japan, of course, continued going up. But even with the greater debt in Europe and Japan, this didn't help the world. It didn't help Japan, didn't help Europe. They're both suffering from debt sclerosis. So what did the emerging markets in China do? They went to the old Keynesian solution, buy now, pay later. And for a while that helped them. But now they are very badly over indebted. And there are a couple of relatively new studies which demonstrate the magnitude of this problem. One was produced by the Geneva Group. It's called Deleveraging. And it shows that the world is significantly more leveraged now than in 2008. And just this month,
McKinsey, just this month I saw.
McKinsey Global Institute. And by the way, that was their third study.
Yes, exactly.
Their third study. The 2010 study is outstanding. And it shows that the GDP is of the global economy is significantly more leveraged. We don't really have any pockets of underutilized balance sheets. We're all in this together.
Lacy, knowing this, where do you see it going? Where do you see it leading over the next 12 to 14 months? I know you concluded in your report that you really believed interest rates would continue to fall in 2015, with volatility, of course.
Well, I don't think we're at the secular low in interest rates, nor are we at the secular low in inflation. When you say we're not at the secular low in long-term interest rates, what you're basically saying is you're not at the secular low in inflation. The trend is downward. Mm-hmm. And it's going to remain downward as long as the indebtedness problem is not dealt with. And it's aggravated when central banks manage to cajole people into taking on more debt. We're not going to solve this problem by ever in larger amounts of debt. And so I think we're facing a difficult process. And now we're seeing evidences of cyclical weakness, not due to the old cyclical causes, but emanating from the debt. I mean, we've got basically stationary growth in Europe, stationary or negative in Europe and Japan. And although a lot of folks won't admit it, the United States is slowing very, very sharply.
I agree with that, actually.
Very, very sharply.
It's amazing how quickly it is and how dramatic and how little public press there is on it. No,
and I think that it's. I mean, we the consumer. The notion was that the lower gasoline prices would really, but you see,
not to an indebted society.
No, doesn't really help you.
Well, it helps reduce the amount of indebtedness they're incurring at the rate they're growing, but they can't. So they're avoiding taking on more debt on their credit card. That's more or less the bottom line.
It is, and there's another technical issue which people don't understand. Currently, we're consuming about 19 million barrels a day of petroleum product. That would include everything. And our net imports are about 5 million barrels. So the import content is about 27%, or 5/19. It's not the old days where it was 75%. You know, we consumed 12, we imported 9. Let's assume that people spend the money rather than save it. The early indications for December and January is that folks are actually saving whatever benefit they're getting from lower petroleum price. They're not putting it in other goods. But let's assume that, say, they shifted to some small ticket item like clothing. These types of items have an import content of 85, 90%. So if you spend less on an item like petroleum that has an import quotient of 27%, and you shift to clothing, what you've actually done is you've created a drag on your economy. Because people forget that in calculating the GDP, we sum up the domestic spending and we strike out the imports. And so this is not the old days. What people talk about a renaissance of American manufacturing. Well, there was really no renaissance of American manufacturing. There was a renaissance of petroleum. 4 years ago, petroleum was about 12% of CapEx and R&D, but it accounted for 35% of the gain in the last 4 years directly, and maybe more indirectly. And so now what you've done is the weakness in global demand, and the weakness in global demand, in my opinion, is what's knocked down the petroleum prices.
Yes, I agree with that. Yeah.
And this is now taking out the most dynamic sector of the U.S. Corporate sector, and the drop in prices, even if consumers were to spend it, the items that they would shift it to are not going to be of benefit to the domestic economy. So there are a lot of problems here, and I think it's going to be a difficult year, unfortunately.
Lacy, what do investors do? What should they be doing, or how should they be positioning themselves?
Well, we're strictly institutional fixed income, so we refrain from making suggestions outside our area of fiduciary responsibility. At Hoisington Management, for the $6 billion that we have under management, we can be in any treasury product. We can be in tips, we can be in coupons, zero coupons, floating rate notes. We can be anywhere on the curve. Mm-hmm. And in fact, we're duration managers, and we make the duration decision based upon where we think the inflationary process is going. And we've been carrying a very long duration portfolio. That's where we are today. That's where we have been. And we think it's justified because the inflationary process is still moving downward. And so we think that if you're willing to be patient and deal with the volatility, you're going to be rewarded. Now, let's just talk about this theoretically. Let's hypothesize for a moment that we go to zero inflation, or perhaps that we go into deflation. Germany today effectively has almost a 1% deflation rate. So do some of the other countries in Europe. Europe as a whole doesn't, maybe an 0.8% rate of deflation. So if you're buying the 30-year bunds, or the 30-year equivalent in Austria and some other countries, you're still getting a 2% real return, because the Fisher equation says the nominal yield is equal to the real rate plus expected inflation. When you algebraically recompose that, It's the real rate is equal to the nominal minus inflationary expectations. So if the inflation rate in an inflationary environment expectations are, say, -1, and your nominal 30-year rate is 1, you still get 2 in real return. Well, the studies show that over long periods of time, in a lot of different countries, what you earn is a 2% real return. For example, in the United States from 1870, the bond yield, the 30-year, not the 10-year, has averaged about 4. The inflation rate was 2. The real rate bounces all over the place short term. In fact, it's so volatile that it's really not predictable. But you don't need to predict it because it's mean reverting. So if we were to go into a zero inflation environment and the bond yield went 2, and then we went into a deflationary environment, went sub 2, you're still going to earn a 2% real return, not the way you would traditionally think about it. But you see, you're going to get paid back in harder dollars. You're not going to be paid back in cheaper dollars. The other thing that investors need to be aware of, and I'm indebted to my late friend Peter Bernstein, who was very helpful to me in some research that I did over the years. Maybe you knew Peter. But Peter's work showed that if you squeeze all the inflation out of your economy, you go to deflation, then the return on risk assets collapses down to 0. Without pricing power, firms have a difficult time, on average, generating earnings. If you let's say you go to 1.5 on the bond with a negative inflation rate of 0.5 or 0.75 of some 1% or something, you're going to have a real return of 2 or a little bit more. And in a non-inflationary, deflationary world, that may be the best you can do. And that's some of the things that investors need to think about it. The rules of the game change as you get down towards zero inflation and into negative inflation.
Lacy, is this really at the core that we're seeing negative nominal rates in Europe? We're seeing bonds from corporations, from BMW to Nestle's, that are negative yields. We're seeing mortgages in Denmark now being at a negative rate. I think I read the other day something like 20% of all bonds now are negative rates in Europe.
Yes, and that's going to create distortions.
Yeah, that's clearly
real serious distortions. Let's say you're a large. Let's say you're a large corporation, and you have a big complex, and you have security, and you have vaults where you keep your corporate secrets and other things. What the corporate treasurers at some point in time will decide to do is to pay their people with cash envelopes. They'll take the euros and put it in their vaults, and they'll pass out envelopes because it's better for them to hold the cash than to pay. That's really not a sustainable situation. It's going to create real serious issues going forward. But the whole process, the reason that this is happening is because of the extreme over-indebted. In the 1930s, the Treasury rates went to 0. It's hard to argue that they went negative. They seemingly went negative for the Treasury bills, but people were given a warrant. If you own Treasury bills, you got a warrant that allowed you to buy the new issue. And so if you imputed some value to the warrant, then you could say, well, we didn't go negative. But there were many bank failures, and having a credible bank to deal with was an issue. So the large, strong banks that had good reputations, what they did was they charged a safekeeping fee of 10 basis points, sometimes more, sometimes a little bit less, 5 basis points, 20 basis points. And people paid the safekeeping fee But that essentially was the negative interest rate. So we've seen this before. It leads to distortions. It seems to me, and there's academic support for this, that the central banks of the world should have just probably stopped in cutting the overnight rate at 1.5 or 2 or somewhere in there, recognizing that they had done what they could do. And instead of trying to take the rates on down to 0, you see, when you bring the rates down like that, push the whole curve on top of the overnight rate or as close to it as you can get it, the banks, to make a profitable loan and put their capital at risk, and the financial institutions of the world are not well capitalized today.
Not at all.
It's one of the problems. And banks and financial institutions don't make loans based upon excess reserves. That's a very, very faulty understanding. They take risk with their portfolio when they have the capital to do so. So when you press the short rates down, for the banks to make a profitable loan, they've got to cover the cost of the money, and their overnight costs are quite low, but they've got to cover their overhead costs. And the banks in the U.S., and which I'm more familiar with, they have huge branch networks, which I really don't think are that profitable to them in the current environment. And I would suggest that the non-interest cost may be as much as 2%. So you've got 0 overnight cost, you've got your non-interest cost, 2%. But then to make a loan to cover the risk premium, the risk that borrower may default. If you're talking, say, a mid-grade business borrower, you need 3% or 4%. So you need 5 to 6. Well, you can't get there. And so the banks basically choke off the lending, which helps address the over-indebtedness problem, but it really doesn't address the over-indebtedness problem, because it mainly only helps the governments and others like that are borrowing for consumptive purposes. It really denies what credit availability is to the entities that have a chance of taking that debt and the funds from it and generating an income stream to repay principal and interest. And so monetary policy is basically, there are no tricks left in the bag. And they basically put themselves out of business. They let their economies become too over-indebted, whether it's the United States or Japan or Europe or wherever. And that's the dilemma we have now.
Lacy, we're up against our hard line. There's so much here to talk about and so much we could go on with. But any closing comments you'd like to leave with our listeners?
I'd like to wish them all good luck. We all need it. We here in Texas need a lot of good luck right now. We're going to be hurt here. It grieves me to say that. But we will not come out unscathed here from this downturn, which is now adversely affecting the energy sector. So I want to wish everybody good luck.
Well, thank you very much for the time. I'm sure our listeners enjoyed it as much as I did. And we've got to have you back later on in 2015. Talk to you later.
Okay. All the best.
Thank you very much for your time. Bye.
My pleasure. Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.